As Joe mentioned, Tesla starts trading in the S&P 500 today, and with a market cap of over $600 billion, it will account for more than 1% of the index. Shares have surged more than 60% in the month since it was announced that it would be included in the index. Joining us right now is Gordon Johnson, GLJ Research CEO and founder. And Gordon, you've been a bear on this stock for a long time. What do you think today as it heads into the S&P 500?
Yes, so thanks for having me, guys. I think that essentially you've had two major catalysts over the past several months. You had a stock split, which essentially is just taking 4 slices of pizza and turning it into 8, and the S&P inclusion. But here's the problem for Tesla. With the S&P inclusion, you're going to have more scrutiny. So what's happened recently? Well, we know that their market share in Europe has went from about 33% to just over 10% Q4 to Q3. Their market share in China thus far this year has went from 25% to now 12.5% from the beginning of this year to essentially now, the most recent month. And we know that in the U.S., when you have 52 new EVs coming next year, competition is going to increase. So when Tesla has seen competition, you've seen a significant drop in their market share. And I think people are going to be more focused on that as there's more scrutiny looked upon the stock.
You know, you've thought that for quite a while, and as we just mentioned, it's up 60% in the last month. There have been people who have been critical of Tesla for a very long time, and it has defied all odds. What makes you think that there's going to be something that actually makes people reevaluate it at this point?
Well, that's a good question. So when you look at Tesla, right, if you take a step back, I think that the general viewpoint is that they're a leader in technology. But if you look at their the key, I guess, remnants of that technology, number one, if you look at batteries, they don't make their own batteries. They buy batteries from Panasonic, CATL, and LG. Anybody can buy those batteries. You look at their manufacturing. Consumer Reports recently ranked them second to last out of 26 cars due to the performance and quality of their cars. And then you look at full self-drive. Navigant ranks them dead last. We know that Waymo and Cruise currently have cars on the road without people in the driver's seat, driving around, picking people up. Full self-drive technology, whereas Tesla, which is level 2, person has to be in the car, person has to be in the driver's seat. So I think as, again, you have more scrutiny on the stock, and most importantly, just as important to everything else, next year when those credit sales, right, over the past, since they've been a company, only 4 quarters have they been profitable, excluding credit sales, the most recent of which was 3Q19. Those credit sales are going to drop away next year as other automakers start selling EVs. So when their earnings potentially turn negative again as those credit sales go away, again, I think the scrutiny on the stock is going to pick up significantly.
Shepard Smith here. Thanks for watching CNBC on YouTube.